Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It's the 5th of January, 2024. Happy New Year. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account and our LinkedIn account. At RenMac LLC is our Twitter account. And go to RenMac Access if you want access to some of our thoughts and ideas, but you're not an institutional client. And again, we'd like to thank our sponsor, Chico's Bond Bailsman, Let Freedom Ring, for sponsoring us this year, 2024. We'll see how long they last, but if you ever if you're in a pinch, give them a call. We're going to talk about payrolls today. We're going to talk about our outlook call, which we did yesterday. Talk about some of the stuff in the markets. But Neil, let's give the floor to you since it is Payroll Friday. The first number of the year, even though it really is the last number of last year. But what'd you make of it?
Yeah, I think the labor markets are fine. Now, the establishment survey did somewhat better than the household survey this month, well, December. And I think that's why yields kind of rose sharply following the news. But, you know, my suspicion is that as the day goes on, that yields will probably come in somewhat. You know, recall that the economy is growing about 2 to 2.5%. And when you look at jobs growth and the work week, total hours worked have basically been flat for the last 3 months. So they were down in December, up in November, and down in October. So they're actually down 2 of the last 3 months. But the economy is growing. We saw this week that unit auto sales were up, right? So what that basically means is if the economy is growing and labor hours are flat, that means that productivity is going up. Labor productivity is going up, which in turn means that unit labor costs are coming down. So there's not much of an inflationary impulse on this based on this data, at least in my view. You know, some of the things that people had been concerned about recently, you know, for example, payroll diffusion, right? I mean, so there was a lot of chatter last month about how, you know, the breadth of jobs growth was quite narrow. But if you look at the data today, the payroll diffusion index rose to 59.6%. That was the highest level since August. So, you know, I think the labor markets are fine. I'm not really concerned about the labor markets. I don't think that they can be used as a rationale, frankly, to justify a more tight Fed or aggressive Fed. I think it's consistent with, I mean, disinflationary growth, frankly. I mean, that's why the work week has been, you know, total hours worked are not rising and growth is. So unit labor costs are down. So if unit labor costs are down, that means that price inflation will be down. It's also not a reason to expect a very, very extensive cutting cycle, right? I mean, this is really consistent with the idea of a recalibration of policy. Not a whole
and you're just to make a finer point on that, you know, markets are expecting something right around the 6 cuts area, and you think that's way too aggressive, correct?
Yeah, I mean, I think right now it's probably 5, but I think 3 to 4 is what's likely. And that's what recalibration means. I mean, I don't think the Fed really wants to change the trajectory of its monetary policy stance, but they do want to kind of get on the right side of the ball here. And, you know, inflation is slowing more rapidly than expected. And the data, frankly, over the last week don't suggest otherwise. I mean, if you look at the JOLTS data that was released this week, the quits rate has been coming down. You know, there's less labor turnover. That suggests that, you know, wage growth is likely to moderate going forward. And as I mentioned today, you know, things like the total hours worked relative to GDP, that signals, you know, lower unit labor costs. The fact that, you know, the household survey, like prime age employment rates came in a little bit. That again also suggests that there's a little bit, you know, some loosening at the margins of the job market. Also consistent with the idea that that wage growth isn't accelerating. And then finally, the NFIB data this week also showed a similar thing where, you know, small businesses are no longer complaining that they're having difficulty finding qualified workers. If they're less likely to complain about that, it means that there's less reason for them to pay people up. So you kind of go down the list. This is all consistent with the idea that the Fed should be surgically cutting rates, not aggressively cutting rates, but surgically cutting.
All right.
Yes.
So we had our outlook call on yesterday, actually. God, how the days fly. And Steve, you hit on a couple really important points. Obviously, we know the election will have the some better data next week, which we'll go over. But let's talk a little bit about the geopolitical side of the ledger and 2024. What's going on? I mean, I thought pretty interesting that expanding the strikes outside of just kind of the conflict region to hit leaders of Hamas. What kind of messaging is that? And I mean, personally, I think it's pretty important to say, hey, this is how we're thinking about it. But give us your take on what's going on geopolitically.
Well, sure. I think the geopolitical risk probably the greatest threat um, that investors should be considering looking into this year and potential disruption, not only around the world, but for the U.S. And right now, I think the Middle East and the fear that that conflict could broaden and maybe include Iran more directly as opposed to indirectly through a lot of their proxies right now is something the Biden administration has really sought to avoid, which is sort of a similar approach to the way they've been very cautious with support for Ukraine, not to try to, again, encourage Russia to expand its footprint. So I guess in that way, it's not surprising. But I think what you noted is really significant. The fact that we've sort of seen a change in course here on Thursday, where the Biden administration actually took out a leader of an Iran-backed military group. Now, granted, it was over there in Iraq, but I don't know that's a coincidence. That came shortly after they also issued a red line with respect to a lot of these Houthi attacks there in the Red Sea. That may have more of an interest, at least to investors at this point, just because of the potential economic disruption when you start rerouting shipping routes, adding to costs, getting into supply chain potential constraints and availability. I would watch if we talk about an expanding conflict. What does that potentially mean for oil? You look at we see a similar blockade or attacks there in the Strait of Hormuz. There are a lot of oil traveling there. It's not clear that there are other options available to transport that. So again, that's something to watch. It's not limited there with respect to geopolitical risk. We also have an election coming up in Taiwan next Saturday, January 13th. If people are interested, we're going to have a guest on Monday, this Monday, January 8th, 10 a.m., Elbridge Colby, to talk a little bit about how Xi Jinping is viewing that outcome there. But I think the big thing just to sort of take away is does Xi feel the need to escalate tensions if the ruling party stays in power, which polls suggest right now is probably the most likely outcome. Then sort of getting beyond that too, we haven't heard as much recently, but going back to sort of oil concerns, there was a lot of talks of whether or not Venezuela was going to try to invade Guyana with respect to oil production and what that disruption potentially could be. So a lot around the world to consider right now.
Yeah, no doubt about it. Obviously, the call on Monday will be important because it's going to help to direct policy or actually the thoughts of how we're thinking about more broadly the economic impact of these things. So stay tuned for that. If you don't have the call link, let us know, and we'll certainly get that to you to listen in. Neil, we had PMIs this week. Was there anything out of the PMI data that jumped out to you? Our market cycle clock's still in a pretty bullish position, which I'll get into, but any nuance to the PMI data?
I mean, not really. As you know, I don't really put much weight on PMIs. I mean, as an example, we saw this morning that manufacturing employment rose for the second month. So we continue to sort of shake out this, post UAW strike slowing. So that should support factory production, obviously. If you're hiring more people, why would you be hiring them to produce less? It doesn't really make much sense. So, my sense is that factory production rose in December, maybe a little bit. And, certainly crude production, so the mining space is doing reasonably well. And we know that crude oil production in the US is basically at a record high. So, I mean, the ISM is a diffusion index. It was really, really high in the early stages of the pandemic, and then it came down. But when you look at the comments of the ISM, which I thought were interesting, the comments are far more positive than the headline number would have you believe. I mean,
Yep.
Some of the industries are talking about growth, about demand picking up, about solid activity and so forth. So, I think it's really, I mean, I'm surprised that the ISM is still below 50. but I also think it's really just a matter of time that it goes above 50. And the reason I say that is because you look at things like South Korean export orders; they've been rising. They wouldn't. I mean, South Korea, as you know, is a country that focuses on the early stages of the supply chain. So that tends to lead final production in places like the U.S. We know that export activity globally is picking up somewhat. So that all suggests that there's room for improvement in factory production and certainly factory sentiment. And as you can attest to, it's not like industrial stocks have been really poor during this period where the ISM has been below 50. So, as a trading tool, I'm not sure how useful it's been to say that, this is a reason to be short the factory sector.
Yeah, no doubt about it. I mean, you can even see it globally, to your point. I mean, you're getting breakouts globally, right? So this is not just the US that has been doing well, particularly in the fourth quarter. I know we've had some softness here in the first week, but that's not a huge surprise. But you're seeing, very close to a trend change in emerging markets. Europe is really on the forefront of leadership. The Nikkei, really, with the exception of Hong Kong and China, most global indices are approaching or at 52-week highs. So very good confirmation from the global markets here. And I think that's an important part that was lacking for much of last year, that this was not really our participation game in terms of what was happening globally. It was really just a domestic game, and obviously people talking about the Magnificent Seven, but we've finally started to see that broaden out, which I think is good news. So our market cycle clock, we updated at the beginning or really end of every month. That ends up being the 15th month, 15th consecutive month, which is tied for the record, which was back in the late 1980s, of being in this bottom left-hand zone, which is that lower inflation, lower growth element that happens to historically be more contrarian than not and give above average returns. What's interesting, Neil, to your point, is if the PMI starts to move up, and that is confirmed by some of these other indications, that starts to keeps the inflation data relatively low, or at least in the bottom third, but improves on the growth side. And if we do that, that's the highest probability shift historically that we see. In other words, going from the bottom left-hand box to the bottom middle box, where growth starts to pick up, not with a coincidental pickup in inflation. That's actually a little bit better, not statistically different, but a little bit better for the equity market. So, if that comes true, that's a pretty good path for 2024, at least in the initial side of the ledger. When we put all these things together, when we put all our indicators together, I put this on Twitter, a chart on Twitter, a bar chart, and we look at the price action, not your world, Neil, of economic data, but just the price action, commodities and styles and sectors and all the stuff that goes into it, the S&P. And we look at that and align it with the previous first rate cuts in a cycle going back to the 1950s. What's interesting is the correlation between what's happening today and the price action and what happened historically is negative. In other words, we haven't ever seen anything like this in terms of the price action relating to what happens today versus history right before the first rate cut. With the exception of 1995. And we've talked about 1995 maybe being a playbook. I'm always reluctant because that was kind of the last one that is still in people's memory. Usually it's something that, has been completely wiped from the memory banks of people. But 1995 actually has a positive correlation with the price action today. So maybe it's this reflection of what's happening. Interestingly enough, what does well, financials do well, healthcare does well. And, maybe even more interesting, and I know there's some nuance around this, you can drive a truck through the variability on a lot of these things, but tech actually did well right to the rate cut in 1994, 95. They cut rates, and then tech went sideways for about 3 weeks, and then actually underperformed pretty massively as we went forward. So maybe that's a curveball here. It's the only time it really did that, but certainly if you're using 1995 as a template and you think that that's something that's going to be important, then you should actually know what's going on in tech, because it wasn't great for tech investors in that period. So we don't see any top formations there. Obviously, there's a lot of bullish sentiment around tech and the like, and so that might be a concern at some point. But I think this broadening of the market's going to end up being more significant than anything, and probably good news for healthcare as we look at that particular sector being in a pretty good kill zone for outperformance for the remainder of 2024. Neil, what's on the docket next week for data?
Next week, the most important data point is going to be the CPI number for December. And then at the end of the week, we'll get the producer price index. And you take those two things, you get an estimate for the PCE data, which is what the Fed looks at. Now, obviously, as you've noted, yields and equities have sort of been moving together, right? I mean, so yields go up, stocks go down. There's been some pushback in terms of Fed expectations because growth has been holding up better than people have thought. I think when the inflation data comes out, it'll probably push yields back down again. I mean, I would expect the inflation numbers to remain quite benign. Remember that in November, we saw a weaker than expected core inflation print, even with used car prices rising. Everything we know about used car prices since then suggests that December was a month where used car prices fell. And we continue to see the disinflation in the pipeline for housing rents. So I think core inflation will be quite soft next week. And, my framework, and I think the Fed's framework, is that weaker inflation numbers matter more than stronger activity numbers. The weaker inflation number will push the Fed to cut more than strong activity data will push them away from a cut. And I think that asymmetry is important for people to understand. Again, that's not a reason to cut aggressively, but it's still a reason to cut. And I think that's the important point. So inflation will be the main event next week.
See, where are we on policy next week?
Well, Congress returns next week, and I think the thing that was notable to me this week was the fact that House Republicans really seem to be digging in more on this border battle with Biden, and to me that suggests that they're not going to be comfortable accepting some sort of Senate compromised version of addressing the challenges there. So when you start looking ahead, January 19th is our first government shutdown date. We also get into February 2nd. To me, it just suggests at this point that the odds of a government shutdown, at least a partial one, at some point are probably increasing. And I sort of get the argument. I understand why Republicans didn't want to shut down the government just prior to Christmas, have all those negative stories about troops and government workers not receiving paychecks, there before the holidays, versus if you feel like you have to shut it down now, earlier in the year. By the time November rolls around, that's an eternity away in terms of politics, so maybe they will be punished less. But I would just, issue a word of caution there because, once you shut it down, it becomes very difficult to sort of reverse course to reopen it. So that's
What do you
what
think
I'd
the
be watching.
probability is?
Of a government shutdown right now, I would say I was at the start of the week prior, like Tuesday, probably at 30%. I'm probably at 40 to 45,
Oh, wow.
and
Okay.
edging higher.
Yep.
That may be a little higher than others see it, but again, that's something to watch, moving forward.
Right. Well, we'll watch these yields. I think yields are just responding to the oversold condition, but as Neil says, it's an important part of the calculus and the chemistry of what's happening in the equity markets. We did end up with 9 straight weeks of gains, and historically that's bullish out the next roughly 10 weeks, a little longer than that. And again, we had the 20-day highs that we're confirming back in the fourth quarter, and that just adds to the higher probability of being in a bull market. And I think that's really kind of the main takeaway from what we saw in the fourth quarter, that was more affirmation of a bull market than it was just a kind of catching people off sides from the excessive pessimism of the early fourth quarter. I think there really was escape velocity, which should play well for 2024. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you like what you're hearing, give us a thumbs up on whatever social media platform you're using to listen to this. In terms of a review, we certainly appreciate that. Special thanks to our sponsor, Chico's Bond Bailsman. Let freedom ring, and we'll take it from this point to next week. Until then, I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
All right, we'll see you.